Welcome to Global Crossroads. For decades, the US dollar has stood as the undisputed cornerstone of global finance, a symbol of stability and power. But in the first half of 2025, something unprecedented happened. The US dollar index plummeted nearly 11%, marking its sharpest six-month decline since 1973. The year currencies began floating freely. This isn't just a market fluctuation. It's a profound shift that carries significant implications for your money and the entire global financial system. Today, we break down what's behind this historic drop and what lies ahead. The numbers are stark. As of July 1st, 2025, the US dollar has sunk 10% since the start of the year, its worst half-year performance in over 5 decades, according to Outlook Business and the Times of India. Against the euro, the dollar fell to its weakest level since September 2021. While the euro surged 13.8% in the first half of 2025, its strongest H1 ever. The yen also strengthened 9% year-to-date, its best performance since 2016. This isn't merely a cyclical dip. As Eric Nelson, macro strategist at Wells Fargo, put it to AFP, it's US exceptionalism basically falling by the wayside and the rest of the world playing catch-up. This potential inflection point, as noted by Goldman Sachs Asset Management, indicates a shift in sentiment that may prompt greater diversification away from dollar-denominated assets. So, what's driving this historic weakening of the greenback? Analysts point to a confluence of factors, many directly linked to the current U.S. political and economic landscape. Firstly, President Donald Trump's unpredictable economic policies have fueled significant market distrust. Repeated flip-flops on tariffs, as seen in April 2025 when new tariffs were reversed after a stock market dip, and fresh spending plans have stoked fears over an uptick in inflation and a ballooning U.S. debt burden, according to Outlook Business and Discovery Alert. Secondly, the recently passed One Big Beautiful bill is a major contributor to investor concern. While the White House touts it for slashing deficits, the Congressional Budget Office projects it will add $3.4 trillion to the federal deficit over the next 10 years, potentially pushing debt to 130% of GDP. This aggressive fiscal expansion, alongside potential monetary easing, has created substantial downward pressure on the dollar. Moody's already downgraded the U.S. credit rating in May, citing these concerns, as reported by Discovery Alert. Thirdly, weakening confidence in the Federal Reserve's independence is a critical factor. President Trump's public attacks on Fed Chair Jerome Powell, including demands for lower interest rates and even calls for Powell to quit, have raised concerns about political interference in monetary policy. This directly dents confidence in the dollar, as noted by Outlook Business and the Atlantic Council. Finally, a broader de-dollarization trend is gaining momentum. Central banks in China and other nations are increasingly diversifying away from the dollar in their foreign exchange reserves, favoring other currencies or assets like gold, according to a survey by OMFIF, Official Monetary and Financial Institutions Forum, conducted between March and May 2025. This trend has been accelerated by Trump's policies, as observed by Harvard economist Kenneth Rogoff, who describes this as the start of a multi-year unwinding of the dollar's dominance. The weakening dollar has a direct, tangible impact on the U.S. economy, creating both challenges and some intended benefits. For U.S. importers, a weaker dollar translates to higher costs for foreign goods and services, squeezing profit margins and potentially leading to increased prices for consumers, according to Monex USA. The National Retail Federation forecasts a 20% year-over-year decline in U.S. imports during the second half of 2025 due to new tariffs and the dollar's weakening position. Conversely, U.S. exporters might find a silver lining. A weaker dollar makes American goods and services more competitively priced in foreign markets, potentially boosting demand. This aligns with the administration's stated goals of strengthening economic self-sufficiency and increasing onshoring of manufacturing. However, this advantage can be offset by retaliatory tariffs from trading partners and increased costs for imported raw materials essential for domestic production. The dollar's retreat has significant repercussions for global markets and financial stability. Foreign investors holding dollar-denominated assets, including U.S. treasuries, see the value of their investments fall when converted back into their own currencies. This has led to substantial outflows from U.S. Treasury markets, pushing government borrowing costs higher and causing volatility, as noted by the Atlantic Council. The Bank for International Settlements, BIS, has even issued a stark warning about the fragility of the global economy, highlighting how the dollar's weakening safe haven status is amplifying concerns about systemic instability within the global financial system. The biggest concern for some, as highlighted by IRIS, a French think tank, is the risk of triggering a currency war. The current turbulence around the US dollar is seen as contributing to a dual fragmentation of the global monetary system, reinforcing the formation of blocs mirroring trade and geopolitical tensions, and thereby increasing the risk of a global financial crisis. Looking ahead, economists offer cautious predictions. Joseph Bruce-Wallace, chief economist at RSM US, calls the current retreat the start of a multi-year unwinding of the dollar's 14-year bull run. JP Morgan Research remains bearish on the dollar for the second half of 2025, expecting emerging market currencies to outperform. While acknowledging the underlying dynamism of the U.S. economy, the Atlantic Council warns that it's harder to regain confidence than to lose it, emphasizing the need for credible deficit reduction and reasserting the Fed's independence to stabilize the dollar's global standing. Our team at Global Crossroads pours extensive research and analysis into every video, aiming to bring you the most accurate and insightful understanding of these complex global forces. If you find this in-depth breakdown valuable and want to stay ahead in a rapidly changing world, please consider hitting that subscribe button. Your support makes this crucial work possible. The decline of the US dollar in the first half of 2025 is more than just a financial headline. It's a powerful signal of shifting global dynamics. Its trajectory in the second half will be a critical indicator of economic stability, trade relations, and the evolving balance of power worldwide. At Global Crossroads, we will continue to dissect these vital trends, bringing you the sharp insights you need. Subscribe to Global Crossroads and stay informed on the forces shaping your future.